Everyone's back, are they? We right to go? Thank you all. Welcome back to the second part of our seminar. Before we move on to Igal Magenzo, the advisor to the Central Bank of Chile, to share some of their experiences in fighting inflation, there was a very interesting question posed just before the break by Mongolia about the bank's plan to deal with the current food crisis. Of course, this has been in the headlines and has been getting a lot of news coverage with the meetings in Rome in recent days. Deepak, do you have something to share with us on that for Mongolia before we move on?
Certainly I will. The question from Ershad from Ulaanbaatar was to explain a little bit about what the World Bank is doing to address some of the pressures, inflationary pressures and shortages resulting from what is now being called the global food crisis. Let me just put this in context. I'm not sure the audience is there yet though in Mongolia. Is everyone there, Irshad? Yes, you are. Okay. Should I continue?
Yes, we are here. We're just people are strolling in. Okay.
Okay.
But we are here.
Maybe we can just wait a couple of moments, and then when you think you have enough people there, we can move on to that question. Let me just, while we wait, run through some of the places, some of the different sites who are joining us here today. Just a reminder that we have people from Indonesia in Jakarta, Also at Mongolia, as we've mentioned, Ulaanbaatar, Papua New Guinea, Port Moresby. We'll come back to them a little bit later perhaps for some questions as well. In Bangkok, Thailand, and Dili in Timor-Leste at the Dili Distance Learning Centre. We'll come back around to all of you after our next speaker to get some questions, but now we'll go back to the question from Ulaanbaatar about the World Bank's response to the global food crisis. Deepak?
Thank you. What I'd like to do in response to the question from Ulaanbaatar is to set this in a little bit of a context, because we need to coordinate among the short-term, medium and longer-term responses to this, because what we're looking for over a longer period of time is a set of supply management responses and a set of risk management responses too, because one without the other will not work. As we learned from this crisis, for example, we have had a lot of faith in the ability of the international markets to resolve any imbalances in supplies and demands for grains. But the international markets sometimes don't function as we expect them to, and therefore you need to have mechanisms in place which would handle these kinds of risks. Now, the kind of the program that we at the World Bank have been talking about, and in this we've been coordinating extensively with a range of partners from the United Nations systems and from other private and public agencies involved in the field of agriculture, agribusiness, agricultural research and supply chains. We can summarize this in about 7 or 8 points. Let me try to mention some of these for you. I think the first step the World Bank has proposed and has taken was to support a full funding of the World Food Programme's emergency needs. The World Food Programme was very quick off the mark in identifying where the shortages were, and we have assisted it in its efforts to purchase food locally around the world and make it available, sometimes hampered, but we hope increasingly unhampered, in the form of humanitarian assistance. We've also moved quickly through our country dialogues and our assistance at the country level to support safety nets, such as distributing food in schools or offering food in return to work, which are standard programs to cope with severe distress of this kind. And here again we work with the Food and Agriculture Organization, the World Food Programme and others to make rapid assessments in what we thought would be 25 vulnerable countries, and make these resources available to them to be able to preserve the social safety nets. A third and most important area, as you probably know, that in most of East Asia, the planting season will be over by the first week of July. And therefore, you need to get seeds, fertilizers, and other agricultural inputs in quickly in time for the fall harvests to be at least at current levels, if not higher. Now, we do expect certain shortages in the region because of events that have taken place, localized droughts, or the situation in Myanmar where the rice exports will probably fall from about 650,000 tons expected this year to about 150,000 tons. Shortages of that kind can occur, but we're trying to prevent that by providing seeds and fertilizers. Now, we've identified 15 priority countries in which we'll do this, but there will be more, I'm sure, over some time. But for this purpose, to be able to meet the requirements here, the World Bank has helped to establish a multi-donor trust fund, and we hope that donors will be contributing actively to this. Again, coordinating a lot with the multilateral institutions, but also with bilateral donors and civil society groups. So the key here is not just financing, but making fast delivery of these fertilizers, using existing networks, and where necessary using alternative systems. The fourth area is, and slightly longer term, is to increase the spending on agricultural supply and research in this area. There has been several years of agricultural underinvestment, but we hope to correct this now. As you know, the World Bank supports, within the World Bank Group is an organization called the Consultative Group on International Agricultural Research, which we support. They've been receiving about $450 million a year. We hope that we will be able to double this investment in research and development over the next 5 years. There's many more of these, but and I think I ought to mention them because there is a comprehensive response required over here. We would like to see much more and much more vigorous promotion of the private sector, especially agribusiness, so that the private sector's ability to work across the entire value stream, not just in production but in post-harvest, minimizing post-harvest losses, in providing the T&V extension services required, in managing the transport and logistics, all the way to actually improving the value added at each, or at least preventing the erosion of value at each step of the global supply chain. These are areas where agribusiness has an important role to play, and we would like to promote that through our different agencies within the World Bank. Risk management and crop insurance. This is something which has fallen off the radar in most places, in most countries for some time. But for small farmers, it becomes very, very important. And where the World Bank is taking some initiatives is to look at the entire range of derivatives, weather-related derivative products, which will help us in this area. So we would have some income compensation schemes for areas where you have large commodity fluctuations or some kind of force majeure which interferes with the supply of agricultural commodities. An area which requires massive international cooperation but is also massively important for the future functioning of agricultural markets is the whole question of subsidies for agriculture in the developed countries, in the OECD countries. And we are trying to work on this to ease the subsidies, to ease the mandates, to look at the tariffs on biofuels, especially biofuels that are derived from corns and oilseeds. So we would like to work more vigorously in this through various fora, including perhaps any conversations taking place in and around the Doha agenda. We are also trying to move with countries on removing export bans on agricultural products. These export bans have led to even higher rice and wheat and corn, but mainly rice exports than price increases than we would have expected. Now there are about 28 countries that have imposed such controls, and we are working with them to see how we can ease these eventually. We would like to conclude the Doha round of negotiations quickly, especially to remove those distortions I mentioned in agricultural tariffs and subsidies. And finally, in terms of this big package of reforms, we'd like to look at the interconnected challenges that exist in the energy market, the food and water market. These are areas which are going to be drivers not just of agricultural production but generally of household security and global security eventually. These are areas we're working on. Now specifically to the question that you had asked, and that is that you've heard about this rapid financing facility. The World Bank has indeed established a rapid financing facility of $1.2 billion, of which about $200 million will be in the form of a grant. And in what we are trying to do is that before the G8 meetings in early July, we would like to identify at least 20 of the most vulnerable countries which could avail of this rapid financing facility. So we are talking about a very short time frame of about 30 days or so, by which time we should identify the 20 most vulnerable countries. Now we've already done so with several of them. Liberia, Haiti, and Djibouti are three countries which had immediate shortages, and we've tried to assist over there. The next three coming up are Togo, Yemen, and Tajikistan, but obviously there will be many more coming down the pike. And this facility is available. The details are being worked out still, and whether any specific countries in the East Asia region are being identified as vulnerable, I don't know, but I'm sure this information can be transmitted to our colleagues in Mongolia fairly rapidly next week.
Deepak, thank you very much for that, and thank you, Mongolia, for raising it. I'm sure that that was not just of interest to you, but of interest to others throughout this region as well. Remember, there is going to be some follow-up question time after our next presentation, so if you have anything else to ask, anything else you'd like clarification on, we can address that then. Let's move on with our with our agenda here, continuing today's inflation, global context and local solutions. Our next speaker has both a global context and a local solution, because they've had to deal with this very much in Latin America, particularly during the 1970s. I think at one point inflation in Chile was around 500%. In other countries, 100% year on year for over a decade. So they've had a lot of experience in dealing with high inflation and how to actually manage it and manage a policy response. So I'd like to introduce now Ignacio Magenzo, his advisor to the Central Bank of Chile. Igal?
Thank you, Stan. And indeed, Latin America is a region that has a very rich experience with inflationary episodes and anti-inflationary programs. This all comes basically from unsustainable fiscal policy and that has been financed with emission. And then comes the anti-inflationary shock therapy programs that most of the times try to achieve at the same time lower inflation, higher growth, low unemployment, and a competitive exchange rate. These programs have succeeded many times in the short run, but had led to crisis in the longer run, even in the medium run, in 3, 4, 5 years. But I think many countries in Latin America have learned the lesson, and during the 2000s, Latin America is going through an unprecedented period of very low and sustained and stable inflation. And this is based mostly on the lesson of not spending beyond the means and running fiscal surpluses in virtually every country in the region. Central bankers are repeating like a mantra that low inflation is the best you can do for the economy, and what has been they're saying what would have been considered an heresy years before, that is that real gains from inflation are very short-lived and are the best way to incubate a crisis. In short, they have learned what economists call that the Phillips curve has a positive slope, but only in the very short term. So what I will do in my presentation, first I will go through inflation and stabilization programs in Latin America as an introduction, and I will also look at the recent surge in Latin American inflation and see what's going on there. Then I will go to recent anti-inflationary measures in Latin American countries. Anchoring expected inflation is one of the measures. Increase in interest rates, the main measure that has been taken. Also changes in trade taxes, export taxes, import tariffs, and I will say very few words about compensating the poor, because much has been said already. Then I will also come to the point of fighting appreciation. Also, we're experiencing, at the same time as we are experiencing high inflation, we are experiencing appreciation of the exchange rate. That's mostly because the region is having big terms of trade gains. This is a region that's a main exporter of commodities, of primary goods, and is going through a period of high terms of trade, which translate into an appreciation of the exchange rate. And there has been tried many things. One is open mouth intervention, just to say that the authorities are worried about the level of the exchange rate, buying international reserves, which is done now virtually in every country in Latin America, maybe the exception of Argentina. I will go into that later. And capital controls in a very few countries, basically 2 or 3 countries, except for 3 countries that have massive capital controls and financial repression, which are Argentina, Bolivia, and Venezuela, which are 3 countries that are following a different path. Concluding remarks, I want to say in advance that there are 2 things that are basic, the basic lessons that Latin American has learned through all these years of very high inflation is fiscal discipline is the basics. There is nothing you can do if you don't have fiscal discipline. And second is policy coherence. You cannot try to achieve too many goals with too few instruments. And I will talk also about other lessons. What we have about inflation in Latin America and inflation stabilization. Here in the table we can see how, well, a lot of numbers in one table, but we can see how many countries, most of the countries, have gone through periods where inflation has been above 100% average yearly for more than 10 years. It's the case of virtually every country in Latin America, with the exception of Panama, which is a dollarized country. And I will go into dollarization also, because Ecuador and El Salvador are following Panama in this respect. The way, the most common tactic to curb down inflation has been exchange rate stabilization programs. But actually, what we have seen is that these programs work in the short run, but most of the times they don't have happy endings. And here I have a quote by Bernd Bernanke, currently the chairman of the Federal Reserve of the U.S. He said that a key lesson of the recent experience is that fixed exchange rates are generally not a long-run solution to problems of monetary and fiscal instability, at least not in a world of high capital mobility. Indeed, despite of early success, virtually all the Latin American exchange rate pegs proved unsustainable and collapsed in a disorderly way. Exchange rate, overvaluation, imperfect credibility of both monetary and fiscal policy, and short duration external debt all contributed to a high incidence of costly speculative attacks and financial crisis in Latin America during the 90s and into the new millennium. I'd say this summarizes very well the experience of Latin America with these exchange rate programs. Now, recently what we have is a new surge in inflation in Latin America. So policymakers are now being put to test whether they really learned the lesson, because during the first part of the 2000 there was not real high pressure on inflation, and now we are seeing this new phenomenon or renewed phenomenon for Latin America. And what we have is what is behind this. So here we have the increase in inflation. What we see is that we have many countries having inflation rates beyond approaching or even going beyond 10% a year, which if you look at the bar here, is the average for the 2000-2006 period, and is going beyond this period of low and sustained low inflation. What is behind this? First, as was already said, is the food price indices, international food prices that are increasing. Virtually all the commodity food like wheat, corn, soybean, rice, etc. This is putting pressure on domestic inflation. Additionally, we have idiosyncratic shocks related to climate phenomenon. The rain seasons are moving around, and this affects also the price of perishable food in particular. And here we have that this is a sample of 8 South American countries, all having over the last 15 months increases in food prices by more than 10%, in some of them by more than 20%, way beyond what was the experience of the first part of the 2000s, where food prices even were going down in some countries. And we add to these two phenomena affecting food, the energy prices in many countries. Probably the most extreme case is the country where I come from, is Chile, and this is due also to international prices and to climate phenomenon, rain season, less rain affects generation of electricity, in these countries, and the price of electricity is going up also very rapidly. This is third, and the fourth phenomenon is the terms of trade gains. Terms of trade gains puts extra pressure on inflation because it boosts demand, internal demand. And in many cases also the fiscal spending, because in many of these countries are owners of the government is owner of commodities, so income of the government is going up very rapidly, and there is a lot of pressure to increase spending. And as I said before, the case of Chile probably is the one that is more contained, and fiscal spending is increasing by as much as 9% yearly, twice as much as GDP, so putting extra pressure on inflation. Also private spending from this extra income that these countries are receiving puts extra pressure on inflation. Now, the terms of trade gains translates also into an exchange rate appreciation, not only increasing inflation. And we see here that, at least for the case of Brazil, Paraguay, Venezuela, I have data until April here, there was a 15% appreciation of the exchange rate, and many of these countries have experienced further appreciation of the currency, even though lately this is relative to the US dollar. And we can see here in this graph that if we plot a bunch of countries and we plot the terms of trade gains and the real exchange rate appreciation, we see a clear correlation between the two, and this is exactly what is happening in Latin America right now. In addition to that, because of high commodity prices, a lot of capital is flowing into the region, and that puts extra pressure on the exchange rate to appreciate. We can see here that capital inflows to Latin America and the Caribbean is going through a historical record. And is expected by the IIF, the International Institute of Finance, is expected to remain high for the next few years, so that puts extra pressure on the exchange rate to appreciate. So we have both at the same time increase in inflation and appreciation of the exchange rate, and I will show you now what these countries are doing to deal with these two things. So the first thing these countries have been doing is invest in credibility, and the way you do that is to build anti-inflationary institutions that can gain credibility. And why is this important? Because if agents expect inflation to go up in unbounded fashion, they will start increasing inflation prices already, and you will have that inflation increases even before you expect it. So on the contrary, if the shock on prices on inflation is expected to be short-lived, only a year or 2 years, then prices will fluctuate much less, and it is much easier to bring inflation back to a low and stable level. How this has been done? Well, Chile was probably the Latin American, not probably, certainly the Latin American pioneer, adopting an inflation target in 1990 after the passage of a new central banking law in 1989 that gave high degrees of independence to the monetary institution. The Central Bank of Chile initial inflation target was between 15 and 20%, so started with a very high inflation, or relatively high inflation, not very high for Latin American countries, but relatively high, and over the decade this went down. Currently, since 2001, Chile has an inflation target that is 3% with a tolerance range of 2 to 4%. So it was brought down in a gradual way. In 1999, Mexico also instituted a formal inflation targeting, started with 52% inflation in 95 and fell to 5% in a few years, and now has an inflation target also from 2 to 4%. Brazil adopted an inflation targeting in 1999, following the collapse of the crawling peg exchange rate regime in the months after the 98 Russian crisis. Also went through a transition period that included monetary and fiscal tightening, and then the president issued a decree in 1999 announcing multi-year inflation target. And what he did, he assigned the responsibility of setting the target to a national monetary council, and gave the central bank full responsibility for implementing monetary policy in order to achieve the inflation target. Also, Brazil moved very quickly to improve communication with the public, and that includes providing inflation forecasts to the public. Other Latin American countries that have turned to inflation target include Colombia in 1999 and Peru in 2002. The benefits of this credibility building are being collected these days. One case is the case of Chile, where we have currently inflation of almost 9%, and if you look at inflation expectations 12 months from now, they are in the range of 4 to 5%, and if you look at inflation expectation 24 months from now, they're in the range of 3 to 3.5%. Very close to the target, and that makes the life of central bank and fiscal policy much easier, because in that way it's much easier to bring inflation back under control. The main policy instrument that has been used in Latin America is increasing reference interest rate. Virtually every country in South America has increased interest rate. Also in the rest of Latin America, we have the cases of Chile, Colombia, Peru, Brazil, Mexico, Argentina, Uruguay, just to mention a few, where all of them have raised significantly the overnight interest rate. In addition, there is the case of Peru that has raised the reserve requirement on deposits, and that less orthodox measure is a very politically convenient measure, and is calculated to have an effect that is equivalent to 110 basis points. So they raise the interest rate 110 basis points through this mechanism that was politically convenient for them, because there was a lot of pressure not to raise further the interest rate. The increase in interest rate in Peru has mounted to 185 basis points in less than a year, which is quite a lot. What is the idea behind raising interest rate is most of these increases in interest rate is done through liquidity management, operating on the very short part of the yield curve. But the main idea is to affect market interest rate, medium-term, longer-term interest rate. So it is very important that the financial system is well developed, and that the financial system understand the measure, so it will translate this liquidity management into market interest rate. There are few examples, experiences trying to manage directly the medium or long or even long-term interest rate. Chile provides some of these experiences, and there have been very unsuccessful. This opens great arbitrage opportunities, and the main and the preferred financial business becomes speculation against the central bank, rather than making the intermediation between savers and investors. Now, Latin America, of course, didn't invent this way of operating. This is the way most developed countries operate their monetary policy, which is affecting the liquidity market. One point that also was touched before is that Latin American countries have recognized that the recent surge in inflation is due to a very big relative price shock. It's not due to internal developments or internal demand developments mostly. In some cases, yes, as I said, because of terms of trade gains and because of capital flows. But mostly it's due to an external shock. So more and more Latin American central banks and fiscal authorities are looking into expected inflation, second round effects, and core measure of inflation. And they are reacting to these indicators, and they're reacting preemptively, so these indicators do not go up. That is very important because evidence shows that once inflation expectations goes up, you start into this spiral of higher inflation, higher second round effects, and that is very costly to bring back, and then we go back to the Latin American experience of many years before the 2000s. Another sort of policies that has been implemented, especially in Argentina, Bolivia, and Venezuela, are export taxes. Export taxes, the idea behind export taxes is that if you restrict the export of certain good, you will detach or make it less sensible to international prices. It does not necessarily matter if you are a big exporter of the good. You can export only very few amount, but once you isolate the good from the international markets, then the price will be determined locally. I have examples here. Cooking oil in Bolivia increased by 70%. Bolivia exports cooking oil to Peru and put a restriction on export, and at the same time has to put more security on the border with Peru. Because Peruvians were coming illegally to buy cooking oil to Bolivia because the price was kept lower, and making shortages in the cities that have border with Peru. Venezuela was very creative and created a certification of satisfied internal demand. So every exporter has to present a certification of satisfied internal demand, and the government will decide whether this particular good is provided internally at a fair price. Argentina, there are taxes on exports on a variety of foodstuff, as well as on oil, biofuels, natural gas, and it's the same purpose, which is to ensure internal demand at below international prices. Restriction on export of natural gas have damaged mostly neighbor countries, particularly Chile. These taxes on exports in the case of Argentina started in 2002 and represent about 4% of GDP, so it's very big. It's 12% of total tax collection is on export taxes. So we're not talking about very particular minor measures, but very big measures to keep prices down. Still, all these countries, Argentina, Bolivia, and Brazil, and Venezuela, have a high inflation, probably the highest inflation in the region. Another measure that countries have been trying is to reduce tariffs on imports, but to tell the truth, Latin America is a very open region with very low tariffs, so these measures are not nearly as important as other examples. For example, in other regions like Turkey, that reduced the import tariffs on wheat from 130% to 8%, or Morocco from 130% to 2.5%. That will have a very big impact, but for the case of Latin America, it's not that important. Another policy has been price controls. Price controls, again, Argentina, Bolivia, and Venezuela are the ones that mainly are using price controls. And for example, in Argentina, they reached an agreement between the government and retailers, mainly supermarkets, to keep most prices frozen and not to increase them. What retailers are doing is trespassing the low prices on providers. And what we have today in Argentina is that the government is facing violent demonstrations from the agricultural sector that is selling their products at very low prices at the same time that they could sell it at international very high prices. In all these three countries, there have been several reports, especially on the press, of shortage, reduced production, increasing stock, and surge of black markets. It is hard to find basic products at supermarkets like milk, poultry. In Bolivia, there are several reports, as I said, of Peruvians passing the border and making shortage in Bolivian cities because of the difference in prices. Additionally, price distortion reduced the incentive to increase production and to invest. And there is a neat case, which is the case of energy in Argentina and Chile. While in Argentina the price has been kept low, there is virtually no investment in energy at this time, and they are much needed. Because of low prices, they are running into a shortage of energy. And the contrary is happening in Chile. In Chile, energy prices are passed to the consumer. Gasoline prices at the pump station are revised every week, depending on the evolution of international prices. Electricity price is revised virtually every month, depending on the evolution of marginal cost. And today we're facing in Chile an investment boom in the energy sector. In fact, there are more projects than the environmental authorities can manage, and we're facing a problem there. So it's really an investment boom. Another example, a huge plantation of soybean in Paraguay is expected to increase 40% soybean. So when you trespass the prices internally, you get more production and higher investment. I want to give another interesting case of price control, which is the flatbread in Mexico, the tortilla. The tortilla is made out of corn, and the price went up in early 2007 by 40%. And after that, the government decided to put a cap on the price, and because tortilla is a basic food product for Mexicans. They eat a lot of it, and they eat everything with it. If you sell the tortilla above the price, you risk 1 to 3 years of prison in Mexico. So they're very seriously about it. Finally, about income compensation, which I put here in bracket because it takes me a little bit out of these anti-inflationary measures. Inflation, as has been said in this seminar before, always hit more the poor. Energy prices and especially food prices affect more the poorer part of the population of each country, and many countries in Latin America are taking measures in this respect. Mexico just announced a program of 17 measures direct to ease the effects of current inflation on the poor. Chile announced a one-time payment for all the older part of the population, also based on the increase on foodstuff. So virtually every country has implemented subsidies and transfers of this kind. The problem again is the extra pressure you put on inflation because of government spending, and that is something that has to be very careful. Now let me go to appreciation of the exchange rate. So the dream of the central banker and of fiscal policy is to devalue the currency at the same time that you reduce inflation. But that is not an easy task, especially for central bank. Many countries in Latin America have tried, the first thing they have tried is open mouth intervention. So open mouth intervention, first of all, is very cheap policy. All you have to do is to talk. And it has proved that has some effect to stop appreciate on rallies. When the currency start appreciating too fast, puts some pause to these rallies. But the main benefit is to prepare the market for an eventual intervention, so agents understand the intervention and react efficiently to it. It also helps to test the political sentiment toward intervention, and many times is used to delay intervention when the authorities are not sure that it's an effective policy or that is the right timing. For example, in Chile, the president of the central bank started showing preoccupation about the exchange rate on January this year, and intervention was done only 3 months later in April. Now, an abuse of open mouth intervention, obviously, without actions to support it, only reduces credibility of the policymakers and probably goes against the effectiveness of monetary and exchange rate policy in general. So be careful. I think open mouth intervention is a good idea, but not to make abuse of it. The second policy is buying reserves. Well, almost every country in Latin America is buying reserves these days. An exception is Argentina, that was buying reserves, but now is facing a capital outflows problem, so is selling reserves. But with the exception of Argentina, virtually every country is accumulating reserves, and they are doing this on the ground of two reasons. First, or they are declaring two reasons. First is to accumulate reasonable level of reserves to face an eventual international liquidity problem. So the main idea here is that if there is a reverse of international liquidity or a major financial crisis in the developed world, or a hike in interest rates due to higher inflation, the region or the particular country will have more instruments to avoid major distortions. What nobody knows is what is the optimal or the prudent or desired level of reserves. There is no way to establish that. Nevertheless, if we look at the level of reserves with respect to M2, to GDP, to external debt, to short-term debt, doesn't seem that the region is in a bad situation. So this justification seems rather weak a little bit. The other justification, of course, is to defend the value of the exchange rate. The main idea is that the acquisition of foreign currency by the central bank can keep a lower and more stable value of the currency.